This is Super Investors in the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
South Garden April of 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul Peter Jones.
Peter Lynch.
I wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is Tom McClellan. You might recognize his last name as his parents were the inventors of the McClellan oscillator and summation index, two of the most valuable technical indicators I've ever come across. But Tom is also a terrific technical analyst in his own right, carrying the torch that his parents first lit back in the 1960s. He's actually come up with some of the most creative and effective stock market models I've ever seen. So I was really humbled when Tom invited me up to Seattle to speak to the Puget Sound chapter of the Market Technicians Association. I used the opportunity to sit down with him and really pick his brain on how these indicators were created in the first place and how he really integrates them into his trading process. At the end of the day, Tom's really one of the most thoughtful and open-minded technicians I've ever come across. But I'll leave you to decide that for yourself. Please enjoy my conversation with Tom McClellan. Tom, welcome to the show. Thanks for doing this. It's really a pleasure for me to be able to pick your brain like this and have the chance to chat about some of the indicators and whatnot that you've come up with in over the years.
Well, and thanks for coming to Seattle. We threw on some good weather for you. I try to tell people if you're planning to come to the Pacific Northwest, then you should know that the rainy season begins around October 1st and it ends September 30th, so you want to work around those days.
Yeah, I know this is my first trip to Seattle, and it's beautiful. I'm getting the wrong idea.
Don't tell everybody.
I live in the Pacific Northwest too, but Bend, Oregon is high desert. I'm on the other side of the mountains in the rain shadow, so I'm a little bit more spoiled in terms of weather. So, but yeah, this is beautiful. Thanks for arranging the weather. You went, I think we chatted before that you actually went to school at West Point.
I did.
I don't imagine they have a finance degree at West Point.
Well, it's a broad-based education then and now. They want to have well-rounded graduates, and so we had Econ 201, early Econ 101, but it had a 2 in front of it because it was sophomore year. And they taught you all about utils and supply and demand curves, and then, so I learned it that way, and I thought, well, this is a bunch of crap. But because it didn't make any sense and didn't give me any real answers. But I got through the semester course and went to study things that made sense. I was an aerospace engineering major. And the great thing about engineering is that there's an equals sign. And everything on the left side of the equal sign equals whatever's on the right side. And so if you're not equaling out, you got to go back and look at the formula and find out where the missing error is. It's very elegant. It's always true. It always works, except when things break, and then you know why they broke because you overstressed it or whatever. But engineering made sense to me. The fuzzy sciences like psychology and economics didn't make as much sense to me, and so I stayed away from those.
Well, that makes a lot of sense to me to hear you say that, because a lot of the research of yours that I've read sounds like it's very evidence based and mathematic in its approach. So
well, and I'll look at anything if I could believe and figure out a way to look at woolly caterpillars and figure out the stock market from them, and if I could test it and show that it works, then okay, fine. But I try to look generally in areas that are more fruitful for exploration.
Yeah. So, well, how did you go from the academy to a career in finance?
Got out in 1982, graduated then, and went off to study tanks at Fort Knox, and then went to flight school at Fort Rucker, Alabama, and learned how to speak Southern.
Yeah.
Had some great barbecue down in Alabama. Not putting down anybody else's barbecue, but it was pretty good. Flew helicopters in the Army for 11 years, including 4 years in Germany. We were there in Germany when the wall came down, which was a fascinating bit of history to live through and be part of. We had, in fact, been to Berlin in 1988, my wife and I, before kids came along, and we'd seen what the divided Berlin looked like. We had to wear our Class B Army uniform because that was what the rules were, and we went over to the east side and spent money stingily and bought all kinds of stuff because of the weird exchange rates that they had going on. Got our picture taken by the little spy guy as we were passing back through Checkpoint Charlie. So we knew what Berlin was like. So it was a very, very big shock. November of '89, I happened to be back in the States, still stationed in Germany, but I was back in the States visiting to find out what my next assignment was going to be in November of '89, and I was staying at my aunt's house in Annandale, Virginia. I went outside to pick up her copy of the Washington Post off her front porch, and here on the Washington Post is a picture of people dancing on the Berlin Wall, and my brain said, no, you cannot do that. This is not real. My brain couldn't process the image that I was seeing, but it was a wild time to be there. Got out in 1993 when smart people came to Washington, D.C., and they figured out we weren't going to have wars anymore, so we didn't need this big army, so let's let everybody go. So I was part of the peace dividend who left the Defense Department and went off to work and earn a living and contribute to GDP and all those things. And when I was growing up, my parents had been involved with analyzing the stock market, and they created the McClellan oscillator and the McClellan summation index that became famous. They did that back in 1969, wrote their book in 1970. But you have to understand, this is before computers, this is before even handheld calculators. So all the calculations were done on scratch paper, all the postings on paper charts were done by hand, so it was a really different time. And, but I didn't want anything to do with what my parents were doing because I was a teenager and I knew everything. It was only when I got older that my parents got a lot smarter.
Yeah, so it's how it works for all of us. So it was really the family business to some degree. I think I read on your site that your parents started tracking the oscillator by when they got a subscription to Barron's. Was that right? Or and tracking it by hand. Right, like you said, there weren't any computers.
Anybody who was tracking advanced decline statistics back then was tracking it by hand on ledgers and graph paper. They got inspired to look at advanced decline statistics by a newsletter that was published at the time called Trade Levels, the Trade Levels Report, published by a guy named Pete Harlan, who was an actual rocket scientist at Jet Propulsion Lab in Pasadena, who in his spare time liked to dabble in the stock market. And so because he had access to a computer, an IBM card-fed, big, gigantic, room-sized computer that they used for tracking satellites and things, he started inputting data onto IBM cards and when getting onto the computer at 3 o'clock in the morning when there was time available and starting tracking the stock market that way. And he was a big fan in the 60s of advanced decline statistics because back in 1962, Joe Granville and Richard Russell, some famous names, they had pointed out how a big divergence between the New York Stock Exchange advanced decline line and the Dow Jones Industrial Average had foretold the big bear market of 1962. It was a 27% decline. So suddenly people were thinking, wow, there's something that could have told us about that. We ought to pay attention to that. And my parents were among those who were suddenly interested in the advanced decline statistics. So they started playing with it themselves and looking at the exponential moving averages that Harlan introduced to the world for tracking stock market prices. Nobody else had done it before. He introduced it to everyone. And they looked at the single moving averages one at a time. But then the light bulb moment came. I'm not sure if it was my dad or my mom. They wondered, what about the difference between the two moving averages? And that was what became known as the McClellan oscillator, and which was the real pearl that they found in looking at these data.
Okay, so that's, the McClellan oscillator and the summation index are the two that I look at and have known about for, since I started looking at, technical studies. Can you tell me a little bit about, how they use them, how you use them, how they're intended to be used?
What they are is they measure the acceleration that is taking place in the advanced decline line. So if you imagine that every day for 3 months we had 200 more advancing issues than declining issues, then you'd see the advanced decline line going up in a straight line with a uniform slope. There would be no acceleration. There would be a rise, but it wouldn't be accelerating upward. It would just be steadily rising. But the market doesn't work that way, so it accelerates upward and then it accelerates downward, and so how you look at how that acceleration is taking place gives you information about what's underlying the market. If you're a deep math nerd, you can think of the McClellan oscillator as the second derivative of the slope of the advanced decline line.
Gotcha. So it's really like a momentum indicator of the internals in the stock market.
Exactly, and it's looking at something other than price, but which is tied to prices, sort of. If you only looked at price, you'll only ever get one answer. The whole reason that you hire the advanced decline line to go to work for you is to give you a different answer sometimes. and to hopefully have that different answer be a useful answer. So that's why it's a useful thing. If you see price and advanced decline data doing the same thing, okay, that's fine. But when you see them doing something different, then you start to pay attention.
So is that what you mainly look for? Is the oscillator to confirm price action?
Either to confirm or to refute it.
Right.
One way or the other, we want to have it tell us what's really happening. And people talk about the advanced decline statistics being problematic because they're not really price. But the nice thing about them is you can't really manipulate the entire market. You can manipulate the prices of some things, but you can't manipulate all 3,100 stocks on the NYSE. Nobody has that much power. And every day there's a battle between the bulls and the bears on every one of those individual issues. And so when you sum up the forces of all those battles taking place on all those issues, sometimes you get a different answer than just looking at the S&P 500 or the Dow Jones Industrial Average.
Well, this actually brings up a question I was going to ask you later, but I think it leads right into it. There's something I've been, thinking about with this huge push to passive investing that we've seen in recent years. I mean, it's over $1 trillion in flows from out of active and almost $2 trillion into passive over the last decade. How does that affect? I mean, I never like to rationalize an indicator, but if we're looking for potential divergence in the advanced decline line to indicate a weakness in the overall market, but the money that's flowing into the stock market is flowing into everything equally because it's mostly flowing into passive products. Does that change the value of the advanced decline line?
That's a really good question. And before we can talk about the answer to your specific question, I'm going to have to adjust everyone in the audience's thinking about money and the stock market. People think about, well, how much money is in the stock market? And the answer is zero. There is zero money in the stock market. If you put money into it, it immediately comes out the other side into somebody else's pocket.
Right.
There's never been a share bought that wasn't also sold. And so if when you hear these lines on TV like, oh, there were more buyers than sellers, well, no, there weren't. There were exactly the same number of shares bought and sold.
Match up.
They have to match
by
up.
definition. Yeah.
And so what the beauty is for analyzing the overall stock market is that there are only two fundamentals that matter. You can forget in terms of individual stocks, company-specific things really matter a lot. But for the overall market, forget book value, forget dividend yield, forget all that other stuff. The only two fundamentals that matter are, number one, how much money is there? And number two, how much does that money want to be invested? If you change either one of those things, you move the market. So we look at liquidity measures that to address number one about how much money is there. We don't care about the grand total numerical value, but we care about whether that's moving. And we look at sentiment indicators that tell us about what's changing with the way that people care about stuff. And those two give us a real good indication. The reason why breadth statistics and advanced decline statistics are so important is that when liquidity starts to dry up, it affects the lesser stocks first. I think of a pig farm. You have a big sow. She just had a litter of 13 pigs. If she's a really good sow, a good mother, and she's producing lots of milk, they're all going to grow and they're all going to be fine. If she's not a very good milk producer, the runts are going to get pushed away. The big piggies will get their share. They'll muscle their way in so the fang stocks can get all the milk that they want, but the runts will go hungry. And so when you look at the mother pig, you can judge her not by the health of the biggest of the piggies. Look at the runts, and that will tell you what's happening with liquidity in terms of being delivered to the market. Yeah,
that's a great point, and it's fascinating to me because I was just talking with Steve Bregman about this the other day. He runs a firm called Horizon Kinetics and has done a lot of research into the passive phenomenon and how it's actually been creating distortions in the financial markets. And he looks specifically at the bond market and finds that passive money flowing into specifically emerging market bonds has allowed a country like Lebanon, essentially 7% bond on their sovereign bonds, to trade to a 5% yield, and it's simply because they're one of the larger issuers compared to the size of their economy, and money's flowing into passive, so the demand for Lebanese bonds is kind of off the charts. And they haven't, to put this in perspective, he brings up the point, they haven't even released a GDP figure in the last 10 years. And people are willing to loan them money, at a 5% yield. So, when the money flows into these passive products, it's just amazing that you would think if there's a runt in emerging market high yield, maybe it's Lebanon.
But this is not a new phenomenon. It
Right.
just happens to be happening in certain ways right now in 2017. In 2008, people saw that the housing bubble had run its course and stock markets had run their course. So everybody got all excited about commodity index fund investing. All the hedge funds were doing commodity index, pouring money uniformly into a basket of commodities. And so suddenly iron ore and rice prices were correlated, which they have no business being correlated. But when you start pouring money into these baskets uniformly, like you're talking about, suddenly correlations go to 1.
So, okay. So I take your point. So you're saying that this is just another momentum trade, and when that momentum starts waning, it will show up in the advanced decline statistics.
Well,
The momentum in terms of flows into these products.
yes, but the flows into those products will start to dry up after liquidity starts to become constrained. And we're not seeing signs of that right now, because right now today the advanced decline line is at a new all-time high. We're not seeing a big divergence. You can still have an ordinary garden variety market correction of a few percentage points anytime, but you don't get the really big drawdowns without a divergence in the advanced decline line. A study we did going back years said if you're at a new 3-year high for the advanced decline line, what's the max drawdown you're going to see? And generally it's 10% or less. There's 2 exceptions to that, though, recently. One was after QE1 stopped, and the other was after QE2 stopped. So when you suddenly yank away the liquidity punch bowl rapidly without any kind of warning or without any kind of taper, then you get these wild liquidity swings. The Fed got smart with QE3 and they said, we're going to pull the punch bowl back slowly, we're going to taper, and didn't cause the same sort of disruptions.
Right. That's fascinating, the correlation. Now, this brings up another topic too. Is that I've talked with a few other folks about the central bank policies, extreme experimental policies, and the effects they have on markets and the business cycle. And I think you have talked about discretionary Fed policy versus a systematic policy of just following the 2-year Treasury yield.
Yep.
And so, do you believe that we should literally just take it out of the hands of the FOMC and put it, just say the Fed funds rate should match the 2-year yield? And
if they would do that, and they won't, but if they did, they would have a lot less of disruption of the financial markets, both in terms of overstimulating and being overly restrictive. The best example was 2004. Finally, Greenspan started allowing interest rates to rise to catch up to this booming economy, but he didn't want to let it catch up too fast because he was worried about his legacy. The 2-year note yield was way up above where the Fed funds target was, and as a result, we got a huge housing bubble stimulated because interest rates were so low. People were borrowing money like crazy and condo flipping and having all sorts of exogenous things that don't make any sense when liquidity is not so plentiful, but they suddenly make sense when the Fed's got its thumb on the scale. And then Bernanke took office in 2005. He kept the party going, and to his credit, he dropped rates faster than any Fed chairman ever had done, but it still wasn't fast enough to catch up to where the bond market was going. If they'd had just pegged the Fed funds target rate to the 2-year note yield and dropped it even faster, then we wouldn't have had as much carnage in 2008 as we had.
And that's a good point. And then subsequent to that, right, we had 7 years of 0% interest rate policy.
And the 2-year note yield was not at 0.
Right.
And we've had all sorts of stimulus. And we've had a great bull market since 2009 in the stock market because, going back to fundamental factor number 1, how much money is there? The Fed has changed that number, and that's why stock prices have been lifted so much. Whether they should be lifted or not, we're not going to get into should. We'll get into that in another discussion. But that's the fact that it has happened that way because of the Fed offering so much extra money to the banking system.
Yeah. I want to. I think these macro discussions are fascinating, and I don't think there are many people that would disagree with the idea that the Fed has been a little too easy over the last 7-8 years, other than economists, who believe that they haven't done enough. But I want to get a little bit more into your process. You're talking about liquidity and sentiment, driving market prices. You've come up with a number of very creative indicators. What are some of the main main ones that you use that kind of underlie your process?
Well, before we get into all the fancy indicators, I'm gonna tell people about what I call the Steve Todd test. Steve Todd writes the Todd Market Forecast down in Crestline, California. He was on Channel 22 in LA, same time we were, and becoming known on financial television way back then. Great guy, and has a deep Southern accent because he's from Alabama. And people asked him what's his favorite indicator, and he said, there's a lot of great indicators, and I like to look at them all, but when it really comes down to it, I really like to strip them all away, just look at a plain old bar chart and ask the chart one question: is you or is you ain't in an uptrend? That's the Steve Todd test.
That's perfect. Right, yeah.
That's the first thing to know: is are you in an uptrend or not?
Right.
Then you can get to the question of is that trend likely to change? But identifying the trend is really important. And we're in a bull market right now. We should be, because all the money that's getting printed. We are, because we're seeing the advanced decline line making new all-time highs. We're seeing prices make new all-time highs. Making new highs in a price chart is one of the most bullish things that a price chart can ever do. It's only the last new high that's the bearish one. And along the way, you'll see a bunch of new highs along the way to that last one that are all bullish ones that you should believe in.
Yeah. So higher highs, higher lows. Definition of an uptrend. That makes
But we look at advanced decline statistics a lot because they give us answers that we can't really get anywhere else. They tell us about how those rents are doing, because everybody gets the same vote. Everybody in every stock or every issue on the New York Stock Exchange, because they're things that are not really stocks, they all get the same vote. Well, it's an egalitarian indicator, and so you'll see when the poorer stocks, when the less deserving stocks are starting to suffer, all of their votes will count a whole lot, and you'll see a difference in the behavior in the advanced decline line.
Gotcha. Now, into aside from the paying attention to the trend, and that's one of my favorite quotes. I think is Paul Tudor Jones is and I'm going to bungle the quote, but he said something like the reason why so many fundamental investors have been crushed in the past 10 years, 20 years during these bear markets is because they just don't know how to read a trend, and paying attention to the trend is incredibly important. So I agree with that completely. But you've come up with some real creative indicators that you look at. One of them is Eurodollar commercial traders in the Eurodollar futures market. Is that a key one that you pay attention to?
It's not the Holy Grail, but it's close.
Yeah.
It's to explain what Jesse just said. We're looking at commitment of traders data published by the Commodity Futures Trading Commission. They're the CFTC. They publish the COT report, the COT report, every Friday. Tells how groups of traders are positioned, either the commercials, which are the big money and the smart money, or the non-commercials, which are the hedge funds, or the non-reportables, which are the nickel and dime futures traders that are so small they're not even worth bothering to report. Paying attention to what the commercials are doing is usually the right way to go. They usually end up being right. When we're talking about Eurodollars, this is not the euro versus the dollar in the currency markets. This is the old term that predates the euro currency, known as Eurodollars, which refers to dollar-denominated time deposits in European banks. So a Eurodollar futures contract is really an interest rate product. People get that confused, and I don't want to let everybody get wrong in thinking that we're talking about currencies.
Euro, right? Yeah.
We're talking about the Eurodollars, which are, think of the LIBOR.
Well, and that's an interesting way to think about liquidity. You mentioned earlier liquidity is a really important thing to watch, and this is liquidity that the Fed doesn't necessarily have control of, because it's kind of dollar liquidity overseas, and so there's different dynamics that are behind this.
Right, and so these commercial traders of the Eurodollar futures, they're the big banks who are laying off their interest rate risk from depositors and from loans they've made by putting that in the futures market so they can de-risk it and hedge that. So the way that they change that hedging that they're doing by going more long or less long or going short, that tells you about the pressures that they're sensing from the liquidity that's within the banking system. But the really fascinating thing is that if you take the net position of the commercial traders of Eurodollar futures, shift it forward on a chart by a year, it'll give you a roadmap of what the stock market is going to do. Why a year? I don't know. But it's only been working for about the last 20 years, and after some point, when you've seen enough evidence that it's working, you start to accept it.
Well, at 20 years too is you look at the process of globalization and how big that euro-dollar market has become over 20 years, it's become much more of a factor, for liquidity in the markets,
Sure.
probably over 20 years than it was before that.
The 3-month euro-dollar futures contract has the most total open interest of any futures contract that's traded in the United States. So it's a huge thing. And it didn't work, this relationship didn't work before about 1997. And before that point, there weren't really the big open interest in euro-dollar futures. It was a very small traded thing, so it wasn't really measuring the dynamic push and pull of all the forces among all the bankers. Once they started embracing it as their hedging instrument, then it started giving out the great answers in about 1997.
Yeah, and you mentioned shifting forward euro-dollars, these positions a year ahead of the stock market. Gives a good leading indicator. That just reminds me of another one that I was looking at on your site, which was shifting oil ahead or 10 years to look at the stock market, and that's another fascinating one.
Yeah.
Where did that come from?
Well, I was doing research in oil prices, and I thought, well, I want to see what the long-term trend is in oil prices. So I got all the data I could find. The old Foundation for the Study of Cycles got a whole bunch of different data on prices of everything and anything they could think of. So they had oil prices back to 1890, which there wasn't very much of an oil market back then, but there was some, and there was pricing. And so I got that, and I looked at it on a chart. I thought, hey, that looks familiar. I know that plot. That's exactly like the plot of the Dow Jones Industrial Average. I thought, well, because we see it all the time that oil prices and stock prices move together. So I put the two of them on the same chart, and it didn't look quite right. They didn't quite line up. I thought, well, what's wrong with this? And so I played around with the alignment a little bit, and I found that if I shifted forward the oil price plot by 10 years on the chart, like if you had two charts on sheets of acetate and you slid them on your desk forward and aft, then you could move around the alignment. We can do that mathematically in charting programs, much easier than printing out acetate. But when you see it on a chart, you see that oil prices and their movements tend to show up again 10 years later in stock price movements. And it's fascinating.
Yeah, it really is. I mean, that's another one I looked at, and I go, "Wow, it really looks like it matches up, really, really well." But this isn't just a couple of examples. You have looked at, atmospheric temperatures and interest rates, and just a variety of things that most people would not think to look at. I mean, where does this creativity and maybe just openness, willingness to look at relationships that seemingly should have no relationship, where does that come from?
It comes from a couple of places. The first place is you have to be willing to accept that there are lead-lag relationships that exist in the world. And just in nature, there's predator-prey cycles. So if you get a bunch of rain and a bunch of grass grows, then a bunch of rabbits will eat all the grass, and they'll have bigger litters of rabbits. And so then, because there's more rabbits, then more ocelots and cougars will be able to survive and not starve to death because they're eating all the rabbits. So sometime after you get a bunch of rain making the grass grow, you get a boom in rabbit production, and then you get a boom in cougar production, and then they overindulge on eating too many rabbits, and then the cougars start to fall, and so there's this general predator-prey cycle in lots of things in the way that nature works. And so you have to be willing to accept that something out there might have the answer that you're looking for, and it might be useful to listen to. So once you accept that, then you can go looking for these things. The second thing that it comes from is I looked at charts for a bunch of my life, and so in my head I have a roadmap of what the stock market looks like. If you give me a 2-year chart of the S&P 500 from any period in the last 100 years, I can probably tell you when it was, because I just know the pattern. And so when I see the pattern that I already know appearing somewhere else, then I can more readily recognize it and put it together that somebody else who hadn't stared at charts for so many years wouldn't necessarily recognize.
Yeah, so some of that's just being around the markets. I was, I've mentioned this book a lot of times recently. It's the Jesse Livermore biography, not the old classic one, Reminiscences, but a new one came out about a year ago called Jesse Livermore, Boy Plunger, and it's a much more detailed look at his career. And he called himself just a pure tape reader, and that was just spending time around the markets and getting a feel for what markets are doing, even if you're not specifically looking at charts. And so I think probably after looking at charts for as long as you have, you start to get a feel for patterns and prices and how they work together. But especially with some of these relationships, it just reminds me of, chaos theory, right? And, talk about a butterfly flaps its wings, one side of the earth creates a hurricane on the other side of the planet or whatnot. There are relationships, and we're finding out through the evolution of math that there are a lot of these interactions that we would never imagine are really out there. But
sure, and the problem that we run into when we think about the source of these answers is we get caught up in the human trap of wanting to know about cause and effect. Like, well, okay, they're related, but what's causing that to work? Well, I don't care about cause and effect if I can be satisfied that a relationship works well enough. I don't care about causation. I care about indication. Who has the answers, and who can give them to me, and are they reliable enough answers that I can make use out of? That's what I care about.
Yeah, but still, I come back to the fact that most investors, think a lot of this stuff is mumbo jumbo. But how do you respond to that or deal with the people who? I mean, obviously, there are plenty of people who say technical analysis is bogus, but there are a lot of people that think a lot of this stuff is just mumbo jumbo.
How do I respond? I try to foster that. I want more people to think it's mumbo jumbo so that they won't all get behind it. If the whole world believed that my leading indicator was a great and truthful indicator, then they would all pile in and they would ruin the effect of it. So I'm just fine with the whole world not believing in it.
And that reminds me of the article that Buffett wrote back in the early 80s called, I think, The Super Investors of Graham and Doddsville. And he said, we're happy to, no matter how much we preach this process, people don't adapt it. And I think maybe that's why he's preaching passive investing today, is that, he doesn't want to breed his own competition. But what do you think is the thing that investors, maybe the greatest mistake that investors make generally, time and time again?
The biggest one is panicking out with everybody else and panicking in with everybody else. We're seeing that with Bitcoin this week. It's doubled in the last month because everybody's piling in and it's the hot new thing. And we've seen this before with tulips and tech stocks and oil prices back in 2008. It's a fundamental human condition that everybody wants to play the hot thing. And then when it's going south and they have to tell their wife that they got to sell the car because they just have lost a bunch of money in the stock market, they panic out at the bottom. And we do this over and over because the human brain is wired to do it that way.
And the panic buying in Bitcoin lately has been pretty phenomenal to watch. Up 10-12% a day. And where did you learn that lesson? Right, because that seems like it's one of the first lessons that we all learn in the markets, or we should learn in the markets, is that panic buying, panic selling. You never want to behave from a place of panic. Where did you? Was there a mistake that you made, or a part in your career where you learned that didn't work so well?
It's usually better to learn from other people's mistakes.
Yes.
But it's tough. The market is, of course, if you've been trading for more than a month, you've made a mistake somewhere along the way, and everybody does. And so you try to learn to not lose very much on your mistakes and make more on your winners, and always try to keep the mistakes to a minimum, but you can't keep them down to zero. So it's generally, I do better when I have an idea from my leading indications what's supposed to happen, and then I turn to my coincident indicators and see, well, what is happening, and are those two in agreement? And then I can trade with greater confidence and greater surety and greater leverage if everything's going my way. When it's not going my way and I'm having to dance around because my leading indicators can be wrong sometimes, or they can be wrong for brief periods of a day or two, or for a month or two, I got to figure out, okay, what is happening, and watch them, put them on the back burner, watch for when they start working again. That euro-dollar commitment to traders data, that's not quite the holy grail, failed completely during QE3. Because the market really wasn't expecting QE3. It wasn't a market liquidity phenomenon. It was the Fed putting its thumb on the scale in ways that those bankers who were trading a year before couldn't have modeled, and it didn't work. So I had to grapple with that, and that was tough because the 2 years prior, 2011 and 12, were great years for me because it was working perfectly.
So that was a time when the Eurodollar futures, the traders were selling off positions and anticipating anticipating less liquidity, and then the Fed came in and provided massive liquidity.
That's very true. The decline that they were forecasting did not happen. So now you might take the position that, well, good for the Fed. They printed over a decline that was going to ruin a lot of people, and that's what they should do. I try not to pass judgments like that. I'd much rather have the Fed do what it's supposed to do instead of monkeying around with my indicators.
Right. Well, maybe they're also watching that indicator and they said, "Whoa, look at the Eurodollars contracts. We got to inject some liquidity here."
I don't have any Fed officials who are subscribers that I know of.
Okay. Well, Tom, I really appreciate you doing this. This is just a fantastic opportunity for me to share your views. I think very highly of your process, and I really want to encourage my entire audience to go check out mcoscillator.com. The Learning Center on the website is fantastic, and you have a breadth of knowledge there that's just a rare resource. So
yeah, people ask when I'm going to write a book, and I really have in that Learning Center. You can sign up for free to get our free weekly Chart in Focus email sent to you, no strings attached. We don't ever send you ads or spam or anything like that. It's just a way to get more people acquainted with their indicators. Been writing that since I think 2009, and so effectively I've been writing a book in serial form all that time, and all those articles are still published in the archives there. And go take a look.
Yeah, that's a fantastic resource. So thanks for doing this.
Thank you, Jesse.
And that does it for another episode of Super Investors in the Art of Worldly Wisdom. You can follow Tom on Twitter at McClellan OSC. And if you're not already following me, I'm at Jesse Felder. And for notes and links related to this episode, visit thefelderreport.com. I'll put up a bunch of stuff related to this episode, including links to a lot of the indicators that Tom was talking about. I want to thank everyone for listening. If you're enjoying these episodes, please do me a favor and leave a review on iTunes. Until next time, buy low, sell high.
Looking good, Billy Ray. Feeling good, Lewis.
Man looks in the abyss. There's nothing staring back at him. At that moment, a man finds his character. And that is what keeps him out of the abyss.